Now, I think the affordability factor is the worst it has been in the last 50 years. One, the average price of a new home in Dallas right now is maybe $420,000. 10 years from now, the average price of a home in Dallas is going to be $1 million.
Single-family rentals are one of the hottest asset classes in the last couple of years. In this video, we're going to hear from Mahesh Shetty, who is the founder and CEO of ILE Homes, which has over 8,000 single-family rentals spread across the Southeast, primarily in Texas. Now, he's going to just talk about the highlights. If you're interested in the full video, I'll have a link to that. But what does he have to say about the future for single-family rentals? It might surprise you what he's learned about his data.
An introduction about him and his business, and hopefully we'll all learn something, meet some new people. So, Mahesh.
Thank you very much. My name is Mahesh Shetty. Normally I say that I'm from far, far East Texas. So I started ILE Homes. When you think about just generally speaking, when I say I'm in the rent-to-own segment, there's a whole taint of these guys are manipulating some. But I started this company 5 years ago. Before that, I was with the hedge fund for about 5 years, and before that, I was with Rodrigo in another commercial real estate company, commercial development. We did about $2 billion in deals over 8 years. Why a sector should be consolidated? Well, it was hopelessly fragmented. Even today, almost 17 years after the global recession, when this industry first came into being, there are only 3% of the universe of single-family rentals is controlled by institutions. So 97% is mom and pops.
All right, well, the second thing you said was there's been some technology in the space that has allowed the aggregation of single-family homes to be much easier and more manageable. I'd love to know what technology you guys use.
We started out building our own technology platform, and what the technology platform allows us to do is to essentially look at the funnel of homes that is available for sale. It doesn't really matter if it's MLS, wholesale, auction, the whole 9 yards. So we are agnostic to what the source is. It comes into a funnel, and we use software to underwrite the home. For example, when you say underwrite the home, we know what the rent number is going to be, which is really the litmus test of underwriting. Rent drives everything else that we do. So rent, location. So we don't buy any properties with swimming pool. We don't buy any properties with solar panels. We don't buy any properties that are on main. So really we focus on bluish white collar neighborhood, which is a big focus is giving them a family friendly environment. So what we want to do is when our customers, when their children leave home for school, nobody knows they live in a rented home. And fundamentally, we think that allows their community to get better and their children to have a better opportunity of success.
So how do you look at getting scale in any one particular market?
Our goal is penetrate and radiate. First you establish your footprint and then keep on buying more homes, and then at some point scale will automatically get us to a point of where the efficiency in operations will translate into a better bottom line. So.
Are you looking and finding deals straight off the MLS?
Most of our business was wholesale and some MLS and some portfolios in the last 2 years. I would say 40% of our business come from new builds.
And then the follow-on to that is what's your discount to the retail that you're actually able to buy those if you do find a bulk deal?
Yeah, good question. So I think we look at the builder's relationship to our sector as an auto manufacturer to car rental companies, right? Oh. So when GM is producing 1 million cars a year, they know, okay, well, Hertz is going to pick up 50, Avis is going to pick up 50, and they'll give them a better discount because what happens is it levels off the manufacturing. It makes it more predictable. So they would rather give the home to you at maybe a 15 to 20% discount as opposed to staying on the balance sheet.
Everything that's happening with fiscal and monetary policy, tariffs, et cetera, where do you see, the prediction question is always interesting from somebody in a seat like yourself.
Hopefully, I'm not that smart to be able to give you accurate.
No,
prediction.
nobody is, but we all like your opinion.
But I think our opinion is that when you look out 5 years from now, we see interest rates, being about 200 basis points below where we are today. We think the fiscal policy and the political environment is actually very conducive to our sector. One, if you slap down on immigration, where's the labor going to come from for construction? And construction from, a large part of the construction comes from immigration. What happens to steel and aluminum and lumber that is coming in from different countries? If that price spikes up, construction costs spike up. If the construction costs spike up, the average cost of a new home is going to go up. The affordability is getting worse. So, and then when the prices go up, the builders are less prone to building new inventory. So then the supply shortage becomes a little more, we are perpetuating the supply shortage, and therefore the home prices go up. As a student, you gravitate to an apartment where the only thing you're looking for is to sleep in that room, if you will.
Right.
You don't care if 10 other guys are in the room, and then you have a girlfriend or a pet. Now you need more space. You don't want to be in an apartment. You go into a home, and you can't buy a home because you don't have the down payment. So we are the bridge to home ownership.
Are we kind of growing more into a nation of renters for the various reasons you mentioned? Construction prices going up, new supply not coming in. How do you view the renter versus home ownership model over time, and how is the country changing in that regard?
I think if you go back 30 years, the percentage of home ownership in a society is somewhere between 60 and 67%. It changes. Mm-hmm. It's a big number, by the way, but when it goes from 60 to 67%, it means that more people are buying, right? Now, I think the affordability factor is the worst it has been in the last 50 years. One, the average price of a new home in Dallas right now is maybe $420,000. Our prediction is that in 10 years from now, the average price of a home in Dallas is going to be $1 million. Mm-hmm. So we are trying to figure out a way to make that happen for our customers. When we think about our customers, how do we get them to a place where they get to own their home and also get their own slice of the American dream?
Do you guys, is it common in the industry to offer a bundle of services as a profit center?
We have not done a great job with that, but I think the opportunity is, for example, you provide them filter service, change the filter, every 6 months, for example. We could also offer lawn service. At a particular size, we can offer them a bundled cable service, where my base model is rent, and it yields X amount on my asset, right? So every other dollar that I pick up in services is incremental, right? And not only that, most of that falls to the bottom line. Multifamily REIT, for example, their average tenant lease is approximately 14 months, whereas if you take that same model and apply it to single-family rentals, it's close to 36 to 40 months, depending on. Only 10% of the apartments have more than 3 bedrooms. So if you want to have a 3-bedroom apartment, your universe is very, very small. So logically, you'd want to go to a home. But if I were to go to new markets, I would go to Phoenix, I would go to Charlotte, I would go to RTP in North Carolina. So there are certain markets that all happen to be in the Sun Belt, and that's where the population is moving. The margin, the delta on margins can be as much as 500 basis points, based on insurance and just real estate access, just those 2 factors alone. We don't do solar because solar is a second lien on the house, and it kind of imposes another burden from a servicing perspective. So like I said, we built our own tech stack, if you will, and what we able to do, is let's assume home 1 to 3 Main Street is being put on the market, right? It comes into our system. We know the rent comps in that particular market based on, we are pulling rent comps at the same time. We're also pulling the AVM, or the value of the house, if you will. Using the rent comps, we're able to assess what the yield is going to be on that particular home. And at that time, we're able to send a contract using our platform to the broker on the other side. And if the broker accepts, then we'll start the due diligence process at that point of time. So the financing, what's happened, we do financing at the portfolio level. The financing is a lot better today than it was, say, 8 months ago. 5-year treasury plus, maybe 200 basis point, maybe 225 basis point, depending on the lender, if you will. Then a lot of the insurance companies have come into the space and made it very, very attractive. Interest only, yeah.
Well, thanks, guys, for coming, and thank you, Mahesh, for everything.
Just a small tip. I don't need to get your hands dirty, but these can. Thank you, everyone, for joining Cornell Real Estate Council. Be sure to check for our LinkedIn page. That's where we continue to post new events, and we'll have monthly events either here or rotating with Plano and maybe some other locations. But please spread the word, commercial real estate type events and institutional level investments. So thank you, guys.